More money making. Today I want to talk about the differences between investing in an individual savings account, or ISA, versus a pension, versus a general investment account, or GIA, and explain how to work out the best option for your circumstances. So let's answer a few questions about each account. First, what are the contribution limits? With an ISA, you can invest up to £20,000 each and every year. If you do sell and withdraw as cash, you won't normally get any extra allowance to put that cash back in during the same financial year. So for example, let's say you invested the whole £20,000 at the beginning of April, but then you withdrew £5,000 in September. You won't be able to invest any more until the following April, since you already used up the whole allowance for deposits. An exception to this is if you have something called a flexible ISA, in which case you can often deposit and withdraw as you please, subject to the usual £20,000 annual limit. For any ISA, if you don't use your annual allowance, you'll lose it. It cannot be carried forward. With pensions, you can invest up to 100% of your earnings for the year, but clamped at £40,000. This is a total amount you can invest in all pensions. So, assuming you have a workplace pension, which you definitely should as I'll explain later, this includes your contributions and also your employer's. You can then contribute the remainder of your allowance into a personal pension should you wish. I discuss pensions in detail in a separate playlist. For simplicity, if your salary is £50,000 and you contribute 10% of your salary, then your contributions are £5,000. If your employer matches this, then your total contributions are £10,000. So you can then still contribute up to £30,000 into the same workplace pension or a separate personal pension. As well as the current year's allowance, if you have unused allowance from any of the 3 previous tax years, you can use something called carry forward to apply these previous allowances to the current tax year and hence allow you to contribute more. There's also a lifetime allowance when it comes to pensions, which currently stands at £1,073,100. This covers all the contributions you make, plus any growth you achieve with your investments. If you exceed this, there will be a tax on the excess called the lifetime allowance charge, the details of which we won't go into here. With a GIA, there are no such limits on contributions, either annually or overall. Next, what tax is applied to profits? Investments within an ISA or a pension aren't liable for any tax on dividends, which is the share of company profits paid out to investors, or capital gains, which is the profit made from the price you sell versus the price you bought at. If you invest in a GIA, you can earn up to £2,000 in dividends and £12,300 in capital gains per year, tax-free. If you earn more than £2,000 in dividends, basic rate taxpayers currently pay income tax at 7.5%. Higher rate taxpayers pay 32.5%, and additional rate taxpayers pay 38.1%. If you earn more than £12,000 in capital gains, basic rate taxpayers currently pay income tax at 10%. Higher rate and additional rate taxpayers pay 20%. If you don't use these allowances in any given year, you'll lose them. They cannot be carried forward. Next, how is each different account taxed, and when can you access the money? With an ISA, you're contributing to it from your post-tax income, so this is money you've already paid income tax and national insurance on, if you're an employee. When you withdraw, you aren't liable for any more tax. You're also able to withdraw money at any time. The same is true with a GIA. You aren't liable for any tax beyond tax on dividends and capital gains while holding that I mentioned previously. With a pension, your contributions are taken from your gross salary, so you essentially save the income tax and national insurance you would have paid had you not made the contributions. For example, for every £1 that you invest into a pension, if you're a basic rate taxpayer, you contribute 80p, while the government contributes 20p. If you're a higher rate taxpayer, you contribute 60p, while the government contributes 40p. And if you're an additional rate taxpayer, you contribute 55p, while the government contributes 45p. With a workplace pension, Your employer is legally obliged to contribute at least 3% of your salary when you contribute 5%. It's very important to maximise your employer contribution since it's essentially free money. For example, if you're contributing 5% and your employer is contributing 3%, that's an automatic 60% return on your investment without taking into account actual investment returns. Some employers even go beyond the minimum required levels. Once money is invested into a workplace or personal pension, you can't access it immediately, since the whole idea of pensions is to encourage people to save for later life. You can't currently withdraw money from workplace or personal pension until you're 55, and this will increase to 57 in 2028. When you withdraw, 25% of your fund is available as a tax-free lump sum. The remainder, since you didn't pay any income tax on the way in, is treated as income in the same way as money you earned while you were working. So, if your income from this, and any other income such as state pension, is over the personal allowance, currently £12,500, you have to pay income tax as normal. The amount you pay depends on whether your total income makes you a base rate, higher rate, or an additional rate taxpayer. So, how do you work out which is the best option for you? If you don't need access to the money until age 55, a pension could be a good option because as it's pre-tax money, more will be invested and compounding for many years before later being taxed on withdrawal. They're an especially good option if you're at least a higher rate taxpayer, since you'd be saving 40% on the way in, and then when you come to draw it out, you'll very likely be a lower rate taxpayer in retirement. For example, if you're a higher rate taxpayer while working, but a basic rate taxpayer in retirement, you've effectively saved 20% tax. However, if you're going to potentially need access before age 55, you don't want money locked away in a pension where you can't get at it, so an ISA could be a good option. Perhaps you're investing for something long-term, but before you reach 55, like providing your children with house deposit or education fees. Or perhaps you want to retire before 55. Any money you do invest should stay there for an absolute minimum of 5 years, and realistically at least 10 years, so you can ride out any short-term market volatility. See my videos on why and when you should invest for a discussion of the reasons for this. If you use up all of your annual ISA allowance, then the next stop should be a GIA account. There are other more sophisticated options, but they're beyond the scope of this video. Some platforms offer an option called Bed and ISA, whereby you invest your money in a GIA and then at the start of the next tax year, when you get a new ISA allowance, you transfer it over to an ISA for tax efficiency. One final thing to note is that there's usually no inheritance tax liability on a pension fund, whereas ISAs and GIAs are liable, assuming the value of your estate is above £325,000, so this could be an important consideration when it comes to estate planning. Thank you so much for watching. I really appreciate it. Please add your own thoughts and follow-up questions in the comments, and I'll try to get through as many as I can. If you made it to the very end, please destroy the like and subscribe buttons and notification bell so you never miss a chance for more money making.